Hello, ladies and gentlemen. I hope you are fine wherever you are. I welcome you all to this presentation on financial instruments. In this presentation, we'll be looking at three accounting standards, that is IAS 32, IFRS 7, and IFRS 9. Okay, now IAS 32 deals with the classification of financial instruments and their presentation in financial statements. It is titled Financial Instruments Presentation. Then, IFRS 9. This one is titled Financial Instruments. The standard deals with how financial instruments are measured and when they should be recognized in financial statements. IFRS 7, with the title Financial Instruments Disclosures. This standard deals with disclosure of financial instruments in financial statements. Perhaps we should start with definition of key terms. Financial instrument. This is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another. Thus, a financial instrument can be a financial asset, financial liability, equity instrument, or debt. Financial asset. This is an asset that is cash. A contractual right to receive cash or another financial asset from another entity. A contractual right to exchange financial assets or liabilities with another entity under conditions that are potentially favorable, or an equity instrument of another entity. Examples of financial assets include trade receivables, options, and investment in equity shares. But don't forget cash. What about financial liability? This is a liability that is a contractual obligation to deliver cash or other financial asset, exchange financial instruments under potentially unfavorable conditions, or that will or may be settled in the entity's own equity instrument. Examples of financial liabilities include trade payables, debenture loans, and redeemable preference shares. Remember, there is a difference between irredeemable preference shares and redeemable ones. We'll talk about this later on in the lecture. Equity instrument. This is a contract that evidences a residual interest in the assets of an entity after deducting all its liabilities. You can see that the definition of equity instrument is consistent with the definition of equity. Okay, so in other words, an equity instrument is like a share. Okay, an ordinary share. Okay, then fair value. This is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This is in terms of standard number 32, paragraph 11, or even IFRS 13. Okay, the definitions are just the same. Now, an illustration of what financial instruments are. From the following, identify which ones are financial instruments. Okay, you can pause the video and then determine which ones are financial instruments and which ones are not. Okay, now go with me. Okay, now inventory. This one cannot be a financial asset, okay, or a financial instrument, because it being a physical asset, okay, like other non-current assets or current assets which are physical, it cannot be a financial instrument. Why? Because there is no present contractual right to receive cash or other financial instruments. Alright? Then, an investment in ordinary shares. This one is a financial asset since it is an equity instrument of another entity. Okay? What about prepayments for goods or services? These ones are not financial instruments since the future economic benefit will be the receipt of goods or services rather than a financial asset. And D, a liability for income taxes. Now, even if this one is a liability, okay, it cannot be a financial instrument since the obligation is statutory rather than contractual. What about a share option? This one is a financial instrument since a contractual obligation exists to deliver an equity instrument at a later date. Okay? How do we recognize financial instruments? A financial asset or financial liability should be recognized in the statement of financial position when the reporting entity becomes a party to the contractual provisions of the instrument. Financial instruments are initially measured at the fair value of the consideration given or received, that is cost plus or minus, in the case of financial liabilities, transaction costs that are directly attributable to the acquisition or issue of the financial instrument. Excuse me. The exception to this rule is where a financial instrument is designated as at fair value through profit or loss. In this case, the transaction costs are not added to fair value at initial recognition. The fair value of the consideration is normally the transaction price or market prices. If market prices are not reliable, the fair value may be estimated using a valuation technique, for example, by discounting cash flows. Now, ladies and gentlemen, all this theory is available in our textbooks, and we have it at our fingertips, but we have discovered that even after months and months reading those textbooks, nothing comes into our head. Okay, so this video is not intended to just follow the textbook. However, I have a diagram here which I hope if you analyze it, if you just take time to write it down or to draw it down, you would be assisted in understanding these financial instruments. Okay, now we have got this diagram, ladies and gentlemen. Okay, we have the financial instruments. Okay, and we say that these financial instruments are in two forms: these financial liabilities and financial assets. All right. Now, when you are talking of financial assets, these ones, they are in two forms. Okay, we've got the debt instrument as well as the equity instrument. Now, an example of a debt instrument is a loan asset. All right, and an example of an equity instrument is a share, an ordinary share. All right. Now, the issue that comes into play, or that vexes us so much, is how do we account for a debt instrument? Now, a debt instrument can be recognized can be measured using three methods. Okay, we've got fair value through profit or loss, and fair value through other comprehensive income, and then at amortized cost. So these are the methods at which the debt instruments can be held or can be measured in our records. Okay, we have already pointed out that initially at recognition, we have to recognize these instruments at fair value, okay, of the consideration given or received, that is the cost or the purchase value of the instrument, plus or minus in the case of financial liabilities. So if it is an asset, a financial asset, you just have to say the purchase value, that is the fair value of the consideration, plus the transaction costs that are directly attributable to the acquisition of the instrument. So in this case, we are talking about debt instruments, so which means we need to, the debt instruments under financial assets, okay, the debt instruments, we are saying we need to recognize them at fair value plus transaction cost. However, there is this, the exception that if we are if we are holding these instruments at fair value through profit or loss, we are not required to add the transaction cost to the fair value at initial recognition. That one is an exception. So only if we are recognizing these assets at fair value through other comprehensive income or at amortized cost are we allowed to add the transaction cost. So this is what is being depicted in this diagram here, where we are saying if we are holding the financial assets at fair value through profit or loss, which is a default category, which means if we have failed to meet the requirements of the fair value through other comprehensive income criteria or the amortized cost criteria, then we need to recognize these financial assets at a fair value through profit or loss. However, we are not required to add the transaction cost, which means the transaction costs are expensed as they are incurred to the profit or loss. Okay, now the fair value through other comprehensive income, here we are saying that we are going to recognize the debt instrument as at fair value through other comprehensive income, which means any changes in the value of the instrument are going to be recognized in the other comprehensive income section. However, we need to satisfy two criteria, that is the business model test and the cash flow characteristics test. Okay, the business model will be to hold the financial asset, okay, to maturity or to sell. Okay, so we have got two options. If we are holding the debt instrument under fair value through other comprehensive income, we are going to hold and then sell. So we are holding this asset and then sell when it reaches maturity. Okay, and then we also have to satisfy the requirement that we are going to receive cash flows at specific dates. We are going to receive some cash flows like the principal and the interest, okay, at specific dates. That's the cash flow characteristic test we need to satisfy. Okay, then we, like I've pointed out, we recognize this asset at the purchase value plus the issue cost. Similarly, under amortized cost, we are going to recognize the asset at purchase value plus issue cost. However, for us to recognize at amortized cost, the two tests should be passed. Alright, the business model test, which means we have got the intention to hold the instrument to maturity, whereas we also have to satisfy the cash flow characteristic test. So what is the difference between fair value through other comprehensive income and amortized cost when we are also using the same test models or the same test? Now, under the fair value through other comprehensive income, the business model gives us two options: either to hold the instrument to maturity, okay, or even to sell whenever we feel like the fair value movement is at our advantage. Okay. Okay. So Under the fair value through profit or loss, here we are simply saying that we are recognizing the assets fair value movements in the profit or loss, and this is a default category if we are failing to meet the business model and cash flow characteristic test, as well as we have not satisfied all the required conditions. So we end up by default recognizing the asset at fair value through profit or loss. The other thing here is that usually the idea of recognizing or of holding the asset at fair value through profit or loss is that we will be having a short-term focus. All right, we are very speculative, and that is we are there to trade. Okay, the idea is that we are only engaged in trade. All right, so the asset will be held for trading and for the short term. All right, now the fair value through other comprehensive income. All right, in this case, I indicated that the business model the business model test will be showing that we are having two options at hand: either to hold the asset until maturity, or even to sell. Okay, we have that option. We actually do not know what we want. Okay, but we just want to keep the options open for us. Okay, so to avoid distortions in our profitability analysis, we then have to recognize the asset under the fair value through other comprehensive income model. All right, and then the amortized test is amortized cost strategy is then used when we are saying our business model is to hold the instrument to maturity. That's the benchmark or the baseline. Okay, we are holding this asset to maturity, and then we need to satisfy the cash flow characteristics test, where we are saying the cash flows are going to be solely the payment of principal and interest. Okay, cash flow of the instrument is based on both the principal and interest. Okay, now that's it for the debt instruments. Now let's move on to the equity instruments. We are saying in this case we have got two valuation techniques. The first one is the default category, where we are saying we recognize the equity instrument at fair value through profit or loss. Okay, and by default this is when we are holding the instrument for trading or for short-term speculative purposes. All right, but if we are going to hold the shares or the instrument for a longer term, then we are recognizing this at fair value. We are going to measure it at fair value through other comprehensive income. Okay, because we are having a long-term focus, and in this case the transaction costs are going to be added. However, if you make this option, it means that it is going to be irrevocable. Okay, we are not going to go back and then say we now want to recognize the instrument or to measure the instrument at fair value through P&L. Okay, don't worry, we'll look at the examples. Now, when we are talking of financial liabilities, here the examiner wants us to appreciate certain things. Okay, financial liabilities are recognized, are measured at fair value through P&L. Okay, if only they are being held for trading. However, they can also be measured at amortized cost. The amortized cost is actually the default position. In this case, we are going to measure the instrument at the cost of the instrument, or the purchase value of the instrument, minus issue costs, minus the discount, which would have been levied upon the purchase of the instrument. We're also going to be required to know the computations and the theory surrounding compound instruments or hybrid instruments. Compound instruments are those instruments which have got two components, the liability component and the equity component. They are accounted for using split accounting, where you need to first determine the liability in present value terms of the instrument liability component and then the equity component. The equity component is usually going to be static. It doesn't change over the years, okay, over the period of the instrument. All right, you see how we do this when we do the computations. Now, let's talk of the determination of whether an instrument is a liability or is an equity. Okay, let's look at redeemable preference shares. Redeemable preference shares are considered a liability. Why? Because the holders of the instrument, excuse me, the holders of the instrument have got right to receive cash flows at specific dates. Okay, these shareholders of redeemable preference shares, they've got the right to receive dividends, whether the company has made profits or not. So in the eyes, or in substance, in the eyes of the accountant, that type of an arrangement imposes a liability on the company. Okay, because whether we want or we don't want, we are going to pay the holders of these shares. So that it is in substance a liability. Whereas when you are looking at irredeemable preference shares, these ones are like ordinary equity. Okay, they do not. Okay, managers have got a lot of discretion over the payment of dividends, and therefore these ones are considered in substance equity. Okay, I think this diagram, ladies and gentlemen, has assisted us to have an overview of what we of the type of war we are going to face, or of the type of arena in which we are going to do our dancing. Okay, so let's move on, ladies and gentlemen, to then now dissect these issues bit by bit, step by step, so that we are not going to be lost in the jungle. Now, financial assets, as you have already seen, are in two forms. Okay, we have got investments in equity, that is equity instruments, and investments in debt, that is debt instruments. Now, how do you classify financial assets? On recognition, IFRS 9 requires that financial assets are classified as measured at either amortized cost, fair value through other comprehensive income, or fair value through profit or loss. We have already hinted out these ones. As you have seen here, we show that we are looking at the fair value through through profit or loss, and fair value through other comprehensive income, and at amortized cost. So those categories are done at the recognition date. Okay, now let's start with equity instruments. Equity instruments are likely to be shares that have been purchased in a company, but not enough to give the investee significant influence. Okay, because when there is significant influence, then it becomes an associate, and it gets out of the scope of IFRS 9. Okay, it becomes an associate, and it will be accounted for under the equity method, that is IAS 28. Okay, so automatically they leave the IFRS 9 scope. So obviously the purchase here, we are looking at the 10% purchase of shares, and we consider this one as a financial investment. All right. Okay, then the purchase again is not going to result in the control of the company. That is, because when control is achieved, then it becomes a subsidiary. Or the purchase is not going to also result in joint control. In any case, it will then be accounted for under IFRS 11 joint arrangement. So you see, you need to have this background to understand what will be going on and so forth. You mustn't be dazzled about these things. Now, there are two options here, depending on the business model of the entity and the characteristics of the financial asset. The default category is always going to be fair value through profit or loss. Okay. Okay. We have already hinted out that the default category here is going to be the profit or loss. Okay. Let me just check here a bit. Okay. I'm saying the default category for equity instruments is profit or loss. Okay. All right. Let's not worry about that. This machine is misbehaving. All right. But you can as well notice in the diagram which I have given you, ladies and gentlemen, that the default category is actually this guy here. Okay, this guy is the default category for equity instruments, that is fair value through P&L. Okay. All right. Now, equity instruments recognized under fair value through profit or loss, or being measured at fair value through profit or loss. Fair value through profit or loss is the default treatment for equity investments where transaction costs such as broker fees are expensed and not capitalized within the initial cost of the asset. This means if equity instruments are held at fair value through profit and loss, no transaction costs are included in the carrying amount. Subsequently, the investment is revalued to fair value at each year and with the gain or loss being taken to the statement of profit or loss. All right, and you just have to have this in your mind that these equity instruments which are recognized at fair value through profit or loss, they are being held for trading or for short-term speculative purposes. If you are having that in mind, then you are home and dry. Now, what about equity instruments which are recognized at fair value through other comprehensive income? Alternatively, equity instruments can be classified as fair value through other comprehensive income if an election is made. It is important to know that this election must be made on acquisition and is irrevocable, so the equity investment cannot retrospectively be treated as fair value through P&L. This is only an option if the equity investment is intended to be a long-term investment, that is, it is not held for trading. Using fair value through other comprehensive income, transaction costs must be capitalized as part of the initial cost of the investment. Similar to fair value through P&L, the instrument would then be revalued to fair value at the year end. The big difference is where the gain or losses are going to be recorded. The gain or losses are recognized within other comprehensive income and included as part of other components of equity in the statement of financial position. This might be referred to as an investment revaluation reserve or similar. In many ways, it is like accounting for property, plant, and equipment using the revaluation model. However, unlike the treatment of for a revaluation surplus related to PVE, there can be a negative, that is a debit balance, on the investment revaluation side. When the fair value through other comprehensive income instrument is sold, the reserve can be left in the investment revaluation reserve or transferred into retained earnings. So, ladies and gentlemen, I think this theory is enough for us to attempt this question. Okay, Benga Co. Alright, so I want you, ladies and gentlemen, to pause the video and attempt this question on your own, and then we go together. Thank you for now. Okay, in February 2008, Benga Co. purchased 20,000 $1 listed equity shares at a price of $4 per share. Transaction costs were $2,000 at the year end of 31 December 20XA. These shares were trading at $5.50 per share, obviously. A dividend of 20 cents per share was received on 3rd September 20X8. Show the financial statement extracts of ACCA at 31 December 20X8 relating to this investment on the basis that A. The shares were bought for trading. Conditions for fair value through other comprehensive income have not been met. So obviously for A, we are being required to make our computations based on the fair value through profit or loss, okay, through P&L. Because as long as the conditions for the fair value through other comprehensive income criteria is not met, then by default the equity instruments are going to be measured at fair value through P&L. Now B, when the conditions of fair value through other comprehensive income have been met. So we need to show the financial statement extracts of ACCA. Alright, so let's do the working, ladies and gentlemen. We'll use the pen. Okay, I guess I'll find the pen here. Alright, good. The pen is now here. So let's start with part A and see, is it possible that I have this question on the screen as well as the paper, yes, the place to do the working. Fantastic. Alright, but I don't know whether you're still seeing this thing clearly. I guess so. So let us go, ladies and gentlemen, together. All right. So for A, let's do A here. For A, the statement of profit or loss, obviously. Statement of profit or loss. This is our extract, ladies and gentlemen, and we just have to be systematic, okay? Because the fair value through P&L says that any change in fair value is going to be a gain or a loss that is recognized in the profit or loss section of the income statement. Okay, so was there any gain or loss? How do I see that? Okay, when we purchased the equity shares, they were $4 per share. However, at the year end, they were now $5.50. So obviously, there's been some share appreciation there. So that appreciation is what we call investment income. Investment income. How much is the investment income? We are saying we bought 20,000 shares. Okay, multiplied by the increase. Okay, 550 from $4 per share. Okay, and we get that total here, and it should be 30,000. Right, then we need to consider the dividend. Okay, there was a dividend that has been received on 3rd September of 20 cents per share. So dividend income. Dividend income. The dividend income, 20 cents per share multiplied by 20,000 shares. Okay, this one should be 4,000. All right, and then we need to account for transaction costs. These ones, like we are told, or as I've already indicated in the diagram and in the previous theory, that if we are recognizing the financial assets, the equity instruments under the P&L category, the fair value through P&L, then the transaction costs are not going to be capitalized as part of the carrying amount of the instrument. Rather, they are going to be expensed as they are incurred in the income statement. So the transaction costs are going to be deducted. They are a cost. Transaction costs. How much? They were 2,000. Remember, this is the transaction cost when we purchase the shares. Sometimes the examiner might say at the year end, if this company wants to sell the shares, they are going to incur this blah blah expenses. That one will be a red herring in your computation because it is not necessary. Okay, it is not necessary. What the transaction costs we are talking about are the transaction costs at acquisition of the investment. Okay, so our income statement is going to show these figures, ladies and gentlemen. What about the statement of financial position? What is going to be shown in our SFP? In our SFP, ladies and gentlemen, we are going to see this figure. All right, the investment, the cost of the investment. So investment in equity instruments. In equity instruments, okay, and we purchased how many shares? 20,000 at how much per share? The purchase value was $5. Was $4 per share. However, at the year end, we are not going to recognize these equity instruments at the cost. Why? Because we are recognizing them at fair value. Okay, so the fair value of the investment is now $5.50 at year end. Please don't make this mistake. Okay, so we are recognizing them at the fair value. All right, so the fair value is now $5.50. So that's the value of the investment at year end, which is equal to $110,000. So that's in the statement of financial position. That's how we are going to recognize these equity instruments under the fair value through P&L. Now let's look at the fair value through other comprehensive income and see what we can come up with. Now, using this one, we are going to say, okay, this is part B. Okay, part B, we are having the statement of profit or loss first. Okay, statement of profit or loss, SPL, all right, and we need our $sign here. Now, in this case, we already hinted out that any changes in gains or losses are going to be included in the other comprehensive section of the income statement. Okay, because here we are looking at the fair value through other comprehensive income. Fair value through other comprehensive income. So any changes in the fair value of the asset are going to be recognized in the OCI, right? The other comprehensive income section. However, this investment paid out dividends. So dividend income is always going to be in the statement of profit or loss. So in the statement of profit or loss section, we are only going to see dividend income. Okay, the dividend income is just the same as we have computed above, $4,000. Okay, then in the OCI section, the OCI section has is going to have a recording of the gain. Okay, there's been a gain on the investment, gain on investment. Okay, how much was the gain? All right, the gain, remember we had purchased 20,000 shares. Remember, 20,000 shares multiplied by the increase. The increase was how much? The increase was All right. Here I want you to understand one thing. There's been an increase of $4. $1.50. All right. That was the increase. However, we can't straight away compute the increase in that way, okay? Because remember, we need to consider the capitalization of the transaction costs. All right, we need to consider the capitalization, the 2000 transaction cost. Remember, there's been some transaction costs when we purchased this, and we said that if we are going to recognize the instrument under fair value through other comprehensive income, then transaction costs are going to be capitalized. So if we capitalize those transaction costs, you will see that the way we are calculating the gain is going to be different. So allow me, ladies and gentlemen, to delete this part. Okay. Now we are going to say 20,000 shares multiplied by $5.50. Okay, that's the first part, minus 20,000 shares multiplied by the original price of $4. Okay, but this one now has to be added to the $2,000, which was the transaction cost, because the value of the instrument at inception was 20,000 multiplied by $4 to become 80, plus the transaction cost of $2,000. That's on recognition, that was the value of the instrument, because we are saying when we are recognizing the instrument at fair value through other comprehensive income, we are going to capitalize transaction costs. Please, this is the trick, and in this exam you are likely to make a blunder and do the P&L way, and you end up failing the question. So here we get how much? We get 28,000, isn't it? That's the amount. 20,000 multiplied by 5.5 minus 20,000 multiplied by 40 plus, this is an addition, this is plus, because we need to capitalize at inception. Then in the SFP, ladies and gentlemen, in the SFP, this is the extract. Okay, we're going to have investment in equity instruments. Okay, and we are going to have the same figure, 20,000 multiplied by the fair value of the equity instrument at the measurement date, or at the reporting date, and this is going to be 110. So you can see that if we are using the fair value through other comprehensive income and the fair value through P&L, the values of the SFP values are going to be the same. As you can see here, they've been the same. All right. However, in our statement of profit and loss, there would be some differences there, as well as there will be an other comprehensive income section, which is going to record some of the issues there. Okay. I hope this question has been given just enough justice so far. All right, and I think I need to bring it to the single page so that you guys see these workings properly. Okay, I'm sure this is the working, ladies and gentlemen, for A and for B. Okay. Now let's move on to the other question. Then our next question should be this one, Zigo. Example Zigo. Please, ladies and gentlemen, just pause the video and try it on your own, and then we'll move together. Okay, ladies and gentlemen, this is our second question. Let's show Zigo. Okay. I guess you can now see it clearer. Now, included within the financial assets of Zigo Co. at 31 March 2009 are the following two recently purchased investments in publicly traded equity shares. Investment 1, 10% of the issued share capital of Harambee Co. This shareholding was acquired as a long-term investment as Zigo Co. wishes to participate as an active shareholder of Harambee Co. Investment 2, 10% of the issued share capital of Ledin Co. This shareholding was acquired for speculative purposes and Zigo Co. expects to sell these shares in the near future. We are also told that neither of these shareholdings gives Zigo Co. significant influence over the investee companies. Whenever possible, the directors of Zigo Co. wish to avoid taking any fair value movements to profit or loss so as to minimize volatility in reported earnings. How should the fair value movements in these investments be reported in Zigo Co.'s financial statements for the year ended 31 March 2009? So this type of question is testing our understanding of the classification theory of financial assets. Okay, we need to know to understand deeper the classification theory. Okay, how do we classify this investment if these are the circumstances? All right, so if we look at investment 1, the 10% of issued share capital of Harambee was purchased. All right, so 10% is within IFRS 9 years. Then this shareholding was acquired as a long-term investment as Zigo Co. wishes to participate as an active shareholder of Harambee. So automatically you can see that this one can be classified as being an investment measured at fair value through other comprehensive income. Okay, so should be measured at fair value through other comprehensive income. Why? Because it is a long-term investment and so forth. Okay, now what about investment 2? 10% of the issued share capital of Ledin Co. This shareholding was acquired for speculative purposes and Zigo Co. expects to sell these shares in the near future. Okay, but you are likely to be dazzled. Here you can actually see that this investment can be measured at fair value through profit or loss. However, there is this statement which can dazzle you because usually the fair value through P&L is avoided by companies who fear that those erratic movements in fair values are going to distort their profits. Okay, so they tend to then end up choosing the fair value through other comprehensive income. However, that option has been specifically superseded by IFRS 9, which says that investments which are being held for sale, when investment is being held for sale for speculative purposes, when the investment is being held for sale, automatically the fair value through P&L applies. Okay, automatically the fair value through P&L applies. So what is our answer given those four options? You can see that D is our answer. Investment 1 is measured at fair value through other comprehensive income, and investment 2 fair value through P&L. Okay, that's the idea, ladies and gentlemen. Let's move on to the next question. What's happening to my case? Okay, we have got this question again, ladies and gentlemen. Let us try it DKCO acquired 9,000 shares in POSACO on 1 August 2023 at a cost of $6.40 per share. DKCO incurred transaction costs of $9,000 for this transaction. DKCO elected to hold these shares at fair value through other comprehensive income. At 31 December 2023, the fair value of POSACO shares was $7.25 per share, and selling costs were expected to be 4% of that amount. Okay, so this I've already indicated to you. I've already indicated that the expected selling cost, this one, is just a red herring, and you need to forget about it. Okay, just forget about it. What is the value of the POSACO shares in DKCO's individual financial statement at 31 December 2023? Okay, so here you just have to stand on your principles, stand on your understanding of these theories, because if you do not stand by the theory, you are likely to fail. Okay. Now, at start, we purchased 9,000 shares. 9,000 shares were purchased at how much? They were purchased at $6.40. Okay, $6.40. All right. Remember, when you recognize an investment using the fair value through other comprehensive income, you include the cost plus transaction costs. The cost of the investment, okay, the purchase value actually, okay, the cost plus the transaction cost to get the carrying amount of the investment. So at the start, we purchased 9,640 plus the transaction costs. How much was the transaction cost? The transaction cost was 9,000. Okay. So this gives you how much? In terms of value, that's 66,600. Okay, you need to use your calculators, ladies and gentlemen, all right, to confirm. And then, if you find that some of the calculations were wrong, please post a comment below this video in the comment section. Please use the comment section to comment. If you find anything you're suspicious about, you're not comfortable with, you just have to. So in that regard, in that way, I would improve on my undertakings. Okay, I'll improve in the way I deliver my lectures. So feel free, ladies and gentlemen, the comment section is open for you. Then, at the end of the period, okay, we still have the 9,000 shares, but the fair value is now how much? They are now 7 to hold these shares, fair value through other comprehensive income. Okay. Okay. They are now trading at $7.25 per share. Okay, so if you punch these figures in your calculator, you must get 65250. Okay, now considering this movement, was there a gain or a loss at the end of the period? Obviously, there's been a loss in the other comprehensive income. Why? Because it is measured at fair value through other comprehensive income. So that's where we are going to take the loss to. Okay, and the loss is how much? 1,350. But now, did we answer the question? Okay, the computation is good. The student is showing that he knows what he's doing. But did we answer the question? Obviously, we didn't answer the question, but at the same time, I wanted you to see what will be going on. Okay, so what is our answer, ladies and gentlemen? Our answer is A, ladies and gentlemen. Okay, this is our answer. Why? Because at the end, that was the value of the investment. Because the question is saying, what is the value of post-accord shares in DK Coast individual financial statement at 31 December 2023? Okay, in another exam setting, the examiner might simply say, tell us the value of the shares as well as the amount that is going to be recognized in the other comprehensive income section of the financial of the statement of the income statement. So this was actually the value, okay, the value, and in the OCI we expect to see loss 1,350 as the loss. Okay, so expect to see the multiple response questions asking you about these two figures. Okay, but in any case, the answer was the required answer was just this part. All right, the value of the investment. This is the part that was being asked for by the examiners. Let's go forward. Okay, ladies and gentlemen, let's move forward with our presentation. We are now at debt instruments. We have finished the equity instruments section. Okay, now it's about the debt instruments. These are usually bonds or loan notes or other instruments which are likely to carry interest and a capital element of repayment. There are three possible classifications for categorizing debt instruments. We've got amortized cost, fair value through other comprehensive income, or fair value through P&L. The classification of an investment in debt instruments should be based upon both the entity's business model for managing financial assets and the contractual cash flow characteristics of the financial asset. Okay, ladies and gentlemen, you need to have this diagram. You need to refer to this diagram all the time. Okay, because most of these things are actually elaborated here. So as I'll be presenting, you need to give reference to this diagram. Okay, now let's move forward with our discussion. Now, this is just a note about equity instruments because you have seen that we didn't touch the amortized cost section or part of classification. Why? This is because the equity instruments do not satisfy the cash flow characteristics that comes with financial instruments. Okay, there is not going to be a specified cash flow to come if you invest in equity instruments. All right, you are not going to be guaranteed that you will receive cash flows at specific dates. Okay, it is your incomes are subject to what managers would decide. Okay, sometimes they pay a dividend, sometimes they don't. All right, so it fails to meet the cash flow characteristics test. So in that case, the equity instruments are held at fair value with changes going through profit or loss unless the investment is not held for trading and the entity makes an irrevocable election at initial recognition to recognize it at fair value through other comprehensive income with only dividend income recognized in profit or loss. So there are only two options for equity instrument, that is the fair value through P&L, which is the default category, or the fair value through other comprehensive income if the investments are not going to be held for trading and the entity has made an irrevocable election. Okay, now let's move on. Now, debt instruments, we have already pointed out that these ones can be valued using three techniques, or they can be classified using three classifications, that is the amortized cost. Sorry, let me look for a pen. Okay, they're saying the amortized, okay, at amortized cost or fair value through P&L, or fair value through OCI. So those are the three classifications. All right. So now let's start with the amortized cost. A financial asset is classified as measured at amortized cost where the objective of the business model within which the asset is held is to hold assets in order to collect contractual cash flows. So the model would be to collect contractual cash flows. Then the contractual terms of the financial asset give rise on specified date to cash flows that are solely payments of principal and interest on the principal outstanding. So these two criteria have to be met. Okay, the two criteria have to be met. All right, let's move on. In the financial reporting exam, that is the ACCA Financial Reporting exam, it will only be the business model test which may or may not be met. So, management must decide on their intention for holding the debt instrument. This treatment requires candidates to demonstrate the principles of amortized cost accounting. The principles of amortized cost accounting mean that interest must be recorded on the amount outstanding. This is relatively straightforward for many instruments. For example, on a 10 million 5% loan with 10 million repayable at the end of the 3-year term, the interest would simply be recorded as 500,000 per year. Okay, so that's 5%. We are saying 5% multiplied by 10 million. And it means that every year there is need for us to pay $500,000 as interest payments. And those are the cash flows. Now, the issues arise when the balance may be repaid at a premium or initial transaction costs were incurred. For example, the terms of the loan, of the 10 million loan issued on 1 January 2021 may be that the holder receives interest of 5% a year, but then receives 11 million back at the end of the 3-year term on 31 December 2023. This means that the holder is now earning finance income in two different ways. Firstly, they are earning the 5% payment each year. Okay. Secondly, they are earning another 1 million over 3 years in the form of receiving more money back than they invested. So in this case, they are receiving a premium. Okay, it means the instrument is now being repaid at a premium. The 1 million, to make it 11 million, the 1 million is now the premium which is being earned. IFRS 9 requires that a constant rate of interest is applied to this balance to better reflect the reality of the situation. This rate takes into account both the annual payment and the premium payable on redemption. In the financial reporting exam, this rate will be provided in the question and is known as the effective interest rate. Let's say that in this example, the effective interest rate is 8.08%. This rate is applied to the outstanding balance each year in order to calculate the interest earned. That is the finance income on the investment, which is the amount to be recorded in finance income in the statement of profit or loss. So we can demonstrate this using a table. All right. Now, this is our table, ladies and gentlemen. Okay. Now we've got the year, that's the first column, and then the balance BD, which is the opening balance. All right. Then effective interest at 8.08%, and then interest received. So, as I've already pointed out, these are the cash flows. Okay, these are the cash flows. Okay, those are the annual incomes which we are going to receive. So, this is interest of 500. Let me just try to use a darker pen. Okay, that's the 500 interest, 500 interest income, and then here we are receiving interest plus the principal of the principal component of 11 million. Okay, so the figures in the effective interest column would be the amount recorded as finance income in the statement of profit or loss. So this is the profit or loss section, the P&L figures each year. So in the first year we record this one. All right, we record the 808,000, and in the next year 833, and then 859. You can see that these figures are increasing as we move towards redemption, because the amounts outstanding will be larger as well. Okay, as you can see here, in the year of redemption, the amounts are now being higher. Okay, they are growing as we move towards redemption, because we'll be paying the principal as well. Okay, so we need to understand that the 11 million figure there is the initial principal of 10 million plus 1 million, which is the premium at the end of the 3-year loan period. All right. So after we paid this amount, it means in the balance, the closing balance will be 0. Okay. It means that we have settled both the interest and the principal. All right. Maybe an interesting part of this would be a consideration of the double entries which are involved in performing this transaction, because if we do not master well those double entries, we are likely to face dilemma in our examination. So let's try to figure out what these double entries would look like. Okay, let's start on 1 January. Okay, on 1 January, let me look for a brighter pen. Okay, on 1 January 20x1, what would be the entry that is relevant? Okay, because we are giving 10 million to a third party. Remember we are lending out. This is a financial asset. We are giving out, or we are lending 10 million to a third party. All right. So we are reducing our cash asset Okay, the cash balance is going to be reduced. Okay, but we are increasing a long-term receivable. All right, so we're going to debit loan receivable. All right, it is a receivable, so debit loan receivable. How much? 10 million. Okay, and credit what? Cash. We are issuing out cash 10 million. That's our first double entry. Okay, now the interest then accrues over the year at the effective interest rate of 8.08%. Okay, this increases the amount of the loan receivable and is recorded in finance income. So the entry is debit loan receivable 808,000 and credit the finance income 808. All right, so let's endorse that one. Okay, so we are going to debit the loan receivable 808,000 and credit finance income 808,000. So far, no movement of cash has happened in terms of the finance income. Okay, let's proceed. So basically, we are saying that over the year, this is going to be happening. Okay, the finance income is going to accrue over the year. All right, at what rate? It is going to accrue at the effective interest rate of 8.8%. Okay, so 8% of 10 million, that's 808,000. Okay, so this will increase the loan receivable. All right, and we need to realize that it is going to be reduced by the interest payments which we will be receiving over the period. All right, so at 31 December, this is what is going to happen. 31 December 20x1. Okay, the entity will receive a payment of how much? Of 500,000. Remember, 500,000 is 5% of 10 million. Okay, so we're going to receive cash of 500,000 being the interest income or finance income. I mean the interest payment, the cash part of it. Okay, 500,000. All right, so in this case, we are reducing the value which is being owed to the entity. All right, so we are going to debit the cash receipt, debit cash 500,000, and credit. What are we crediting in this case? We need to be very realistic. Okay, we are crediting the loan receivable. Sorry, the loan receivable. We are reducing the loan receivable. Remember, this loan receivable is an asset. It is us who has lended out money. Okay, we are not the borrowers, but we have lended out money. We are the lenders. Okay. Now, what is the result of these entries? All right. The result is that the entity has a closing loan receivable of how much? We are saying we had 10 million receivable at the start. Okay, sorry. At the start we had 10 million, and then we increased the receivable by the finance income. Okay, the finance income of 808, that is 0.808. Okay, minus the payment of 0.5. So in this case, we are going to rest our case at we're going to let me use this calculator at 10.308 million. All right, that's the resulting receivable, okay, at the end of first year. So at 31, this is the resultant receivable. Resultant receivable. Okay, the loan receivable is 10,308. Okay, so this would carry on for the next 2 years until the full amount is repaid at 31 December 20x3. All right, with the entry. So at 31 December 20x3, we expect this type of entry where we would say debit cash 11 million. All right, and credit loan receivable, the loan receivable 11 million. Remember, we are going to receive the principal plus the premium at the end of year 3. So at 31 December 20x3, we will be receiving our 11 million. And in that case, we will be closing out any outstanding receivable. There will be a 0 outstanding receivable. So all in all, the total finance cost should be 2.5 million. How does it come to 2.5 million? You can see if you add these figures, the total finance income, actually, the total finance income, if you add this figure 808 plus 833 plus 859, you must come to 2.5 million. That's the total finance income, and this was being recorded in the profit or loss in each year. However, you need to appreciate that this 2.5 million is found from all right, let me just try to use a brighter pen here. Okay, the 2.5 million includes the 1.5 million and the 1 million. The 1 million being the premium. Remember, premium, because the original principal was 10 million, but we are going to receive 11 million. So the 1 million is the principal. Okay. And what about the 1.5 million? The 1.5 million is actually the total of interest payments. The total of interest payments or interest payments received. Remember, we received 500 plus 500 plus 500, this one, and that makes 1.5. So in total, we have received 2.5 million in the form of interest plus the premium. Okay, and this has been accounted for using the effective interest rate, and in our income statement, we recognize this income systematically over the duration of the investment. Okay, now let's talk a bit about those investments the debt instruments which are recognized in fair value through other comprehensive income and fair value through profit or loss. Okay, because here we were looking at the amortized cost part of it. Now let's talk a bit about the other recognition criteria or measurement basis. Now, debt instruments, fair value through other comprehensive income. Now, this is another possible treatment of holding the debt instruments, where we are saying we'll be holding them at fair value through other comprehensive income. Similar to holding the instrument at amortized cost, two tests must be passed in order to hold a debt instrument in this manner. There should be a pass in the business model test. The objective of the entity's business model is both to hold the financial assets in order to collect the contractual cash flows and also to sell the asset. This might include sales to manage liquidity needs or in order to maintain particular interest yields. So we are saying the business is caught between the advantage of holding the asset to maturity, where in that case they will be inclined toward receiving contractual cash flows, okay, those interest payments, the interest incomes, as well as the principal. However, if along the way the business determines that there are some fair value advantages attached in towards movements in terms of share appreciation, value appreciation of the instrument, then in this case they can sell the instrument. So they've got two options. All right, they've got two options, that they can receive contractual cash flows, but at the same time they can sell the instrument when they feel there is need. All right, that's the business model. So in that case, if they have got those two options, then we will be inclining toward the fair value through other comprehensive income basis. All right, now when you are talking about the contractual cash flow characteristics, the contractual terms give rise to cash flows which are solely repayments of the interest and principal amount. We have discussed about this. So again, it is only the first of these two tests that candidates will need to consider in FR exam, that is the financial reporting exam, highlighting that the choice of category will depend on the intention of management. So automatically, if the business model is passes, therefore then you need to recognize the debt instrument and fair value through other comprehensive income. Okay, so those are the further details which you can refer to. You can pause the video and complete the reading. All right, let's move on. Now, debt instruments, fair value through profit or loss. Okay, financial assets should be measured at fair value through profit or loss unless they are measured at amortized cost or fair value through other comprehensive income. For example, an investment in debt instrument which is held for trading and therefore fails the business model test for amortized cost and fair value through other comprehensive income should then be recognized in fair value through P&L. All right, so usually the P&L valuation category is, the fair value category should be used if we are talking of trading or short-term investment. Financial assets measured at fair value through P&L should be revalued at each year end, with any revaluation gains or losses being recognized in the statement of profit or loss. Okay. Now, let's talk a bit about the impairment and uncollectability of financial assets. The new payment model in IFRS 9 is based on providing for expected losses rather than dealing with losses after they have arisen, and applies to financial assets held at amortized cost and fair value through other comprehensive income. All right, so which means all those financial assets which are recognized under fair value Just look for this pen. Okay, all those assets which are valued through fair value through P&L, the P&L are not impaired actually. Okay, so or are not considered for expected losses. Why? Because they are by default being accounted for directly in the statement of profit or loss. Okay, so their impact, their losses or their gains is automatically being considered. So we do not have to do the expected loss procedures. Okay, also because they are short-term in nature, right? 3 months investments and so forth. So these ones are there's no point in worrying about the credit loss allowances and so forth. Right? So if it's necessary that all those instruments are classified as measured at fair value through profit or loss are not going to be considered for any expected losses. All right, so let's move on. Okay, so we have ruled out that if the financial instrument or the financial asset is being classified as measured at fair value through P&L, then the expected losses model is not going to apply. Okay. Now, the financial statements should reflect the general pattern of deterioration or improvement in the credit quality of the financial instruments. Okay. Upon initial recognition of the asset, the entity creates a credit loss allowance equal to 12 months expected credit losses. This is calculated by multiplying the probability of a default occurring in the next 12 months by the expected credit losses that would result from that default. Okay, an example of this is where we are saying that we've got receivables of 10 million. Okay, let's say the receivables are of 10 million. All right, but we know that from past experience, 5% are likely not to pay. Okay, they are likely. So the 5% are doubtful. All right, they are doubtful. So in this case, we need to have to determine the probability of them not going to pay. Okay, so 5% of 10 million would be so our credit loss would be like the credit loss allowance would be 5% of 10 million multiplied by the probability of them not going to pay. You see, maybe there is a 20% chance that they are not going to pay. Okay, so multiply by 0.2. So this might 5% of 10 million, that's 500,000 multiplied by 20. So you end up having an allowance of 100,000, which is going to be recognized. So our receivables balance would be, the receivables would be 10 million less the credit loss allowance of 0.1 million, and we'll be having 9.9 million as our receivable. So do not forget that in this case, the credit loss allowance is like the computation of an expected value. Okay, the expected value technique. All right, so if the credit risk increases significantly, subsequent to initial recognition, then the allowance recorded to represent the 12 months expected credit loss is replaced by an allowance for lifetime expected credit losses. If credit quality then improves, the 12-month loss basis is reinstated. So when you're talking of lifetime now, this is now longer term, okay, where we'll be giving the credit loss allowance for over 1 year, 2 years, 3 years, and so forth. So that's what we'll be doing. The movement in the allowance is recognized as an impairment gain or loss in profit or loss. Okay, so whether the asset was being held at amortized cost or at fair value through other comprehensive income, as we have already indicated that these are the two bases in which the credit loss model is which the expected losses model is applied or is applicable. Then if there is an impairment gain or loss in these instruments, then they should be recognized in profit or loss regardless of the measurement basis. Okay, and as I have already pointed out about financial assets carried at fair value through profit or loss, under these ones, the losses are recognized in profit or loss. Okay, as I've already indicated, any payment loss should be recognized in net profit or loss for the year, even though the financial asset has not been de-recognized. So what this wording means is that if the asset was being recognized or was being carried at fair value through other comprehensive income, any deterioration in value would lead to a de-recognition. However, if the asset was being carried at fair value through P&L, then there is not going to be a de-recognition of the asset on the statement of financial position. Okay, it will be as indirect as it is. However, any movement is only going to be expensed. Okay, any movement of an asset which is being carried at fair value through P&L is going to be expensed, but the asset's carrying amount will not be affected. Okay, the asset's carrying amount will not be affected. The impairment loss is the difference between its acquisition cost, net of any principal repayment and amortization, and current fair value for equity instrument or recoverable amount for debt instrument, less an impairment loss on that asset previously recognized in profit or loss. So this is how, ladies and gentlemen, we need to look at these issues. These measurement bases, they've got an impact on how you are going to value your financial assets in the records. And as a recap, I indicated that if we are valuing the asset, or if we are carrying the asset at fair value through P&L, then any gains or losses are only going to be recognized in profit or loss. And any impairment loss should be recognized in net profit or loss for the year, even though the financial asset has not been de-recognized. So in this case, even if we determine that at the start of the year, the financial asset was worth 10 million, okay, however, there have been some movement in the fair value, okay, to say that the fair value is somewhere around 8 million. Okay, the decrease here is not going to impact the fair value of the instrument in our records. Okay, it will still remain 10 million. However, the impairment is only going to be expensed. Okay, the 2 million, remember the difference. The 2 million is going to be expensed. However, this is only done for short-term speculative investments. All right, this is only an issue of short-term speculative investments which are being held at fair value through P&L. Okay, and the formula for this impairment is that it is the difference between the acquisition cost, okay, net of any principal repayment and amortization, and current fair value for equity instruments, or recoverable amount less an impairment loss on that asset previously recognized in profit or loss. Okay. Now, these are the further notes. Impairment review gives evidence of financial asset being impaired. Original effective interest rate should be used when discounting future cash flows to calculate the impairment. Impairment loss is charged to profit or loss. When investment in equity instruments suffers impairment loss, this is recognized in statement of changes in equity and other comprehensive income. Where the investment in equity instrument suffers impairment loss, this is recognized in statement of changes in equity, other comprehensive income. So basically, if the investment involves equity instruments, okay, and it suffers impairment loss, obviously the impact should be felt in the OCI section. Okay, the loss is to be reported in the OCI section. All right, so if specifically the impairment loss is targeting the investment in equity instrument, then the other comprehensive income section has to report that movement. Okay, but basically the impairment losses are to be charged to the profit or loss. And also be in mind that this issue of impairment is only going to affect the asset values in the SFP for those financial assets which are being carried at amortized cost or fair value through other comprehensive income, and not those ones which are carried at fair value through P&L. Okay, that's a trick there, and you need to brace up for it. All right, what's going on with my pen? It's freezing. All right, can't see the part, not a problem. All right, do we still have other issues here? All right, let's talk of factoring. All right, the business model test must be considered in the case of factoring. All right, where debts or receivables are factored, the original debtor sells the debt to the factor. Remember, factors are like agents, okay, debt collection agents, but they charge a fee for their services. All right, so where debts or receivables are factored, the original debtor sells the debt to the factor. The sales price may be fixed at the outset or may be adjusted later. It is also common for the factor to offer a credit facility that allows the seller to draw upon a proportion of the amount owed. An entity may have a past practice of factoring its receivables. If the significant risks and rewards are transferred from the entity, resulting in the original receivables being derecognized, the entity is not holding these receivables to collect the contractual cash flows, but to sell them. However, if the significant risks and rewards of these receivables are not transferred from the entity and the receivables do not therefore qualify for derecognition, the entity's business objective is to hold the assets to collect contractual cash flow. In order to determine the correct accounting treatment, it is necessary to consider whether the control of the debt has been passed on to the factor or whether the factor is in effect providing a loan on the security of the receivable balances. If the seller is to pay interest on the difference between the amounts advanced to him and the amount that the factor is received, and if the seller bears the risk of non-payment by the debtor, then the indications would be that the transaction is in effect a loan. I think we need to present this in the form of a diagram. Okay? Alright, but before that, let us talk about this aspect. Okay, now let's talk about the required accounting treatment when in as much as factoring of receivables is concerned. When the seller has retained no significant risks and rewards relating to the debts and has no obligation to repay amounts received from the factor, the receivables should be removed from its statement of financial position and no liability shown in respect of the proceeds received from the factor. A profit or loss should be recognized, calculated as the difference between the carrying amount of the debt and the proceeds received. When the seller does retain significant benefits and risks, a gross asset equivalent in amount to the gross amount of the receivables should be shown in the statement of financial position of the seller within assets, and a corresponding liability in respect of the proceeds received from the factor should be shown within liabilities. The interest element of the factor's charges should be recognized as it accrues and included in profit or loss with other interest charges. Other factoring costs should be similarly accrued. Please note, receivables can be factored with recourse, that is, significant benefits and risks retained, or without recourse, the benefits and risks not retained. Let's have a look at this following diagram. Now, you can see factoring has two options, with recourse and without recourse. In a with recourse arrangement, the risk and reward, and therefore control, is not transferred to the factor, but it remains with the seller. Therefore, the receivables are not derecognized, and we treat the proceeds as loan. So in this case, we debit the cash received from the factor and credit loan. Okay, so it is a matter of risk and reward. When we are talking of risk, we are talking of about the non-payment of the amount owing. Okay, and when you are talking of reward, we are talking about the possibility of payment. Okay, the payments which are going to be received, or the benefits which are going to accrue. Now, in a without recourse arrangement, the risk and reward, and therefore control, is transferred to the factor. The receivables are derecognized, and we treat the proceeds as a reduction in receivable. Okay, so in this case, we debit the cash that has been received and credit the receivable. Now, I think we've done everything that was possible with regard to financial assets. Now, let's then move to financial liabilities. Remember, there was a statement that whenever a financial instrument was to be recognized, it was to be recognized at fair value. Okay, fair value plus issue costs if it was a financial asset. Okay, although there are certain exceptions. All right, but when it comes to the valuation of financial liabilities at initial recognition, we were saying that we need to deduct the issue costs and also some discount that was given. All right, now after initial recognition, all financial liabilities should be measured at amortized cost. All right, they should be measured at amortized cost. With the exception of financial liabilities at fair value through profit or loss. This should be measured at fair value, but when the fair value is not capable of reliable measurement, they should be measured at cost. Remember this diagram, ladies and gentlemen. All right, and I indicated that financial liabilities should be either measured at fair value through profit or loss, okay, only if they are being held for trading, or at amortized cost, which is the default position. And we say that you initially recognize them at the purchase value, or the cost of the asset, the price of the asset, less any issue cost, less any discount. All right, so this diagram, ladies and gentlemen, is going to be our passport. All right, now let's move on. In the financial reporting exam, financial liabilities will be held at amortized cost. So always know that the financial liabilities are going to be held at amortized cost. This will be similar to the measurement treatment shown earlier for assets held under amortized cost. Instead of having finance income and an asset, there will be a finance cost and a liability. Remember when we were doing the amortized cost computation for the loan receivable, we were recognizing a loan receivable as well as finance income. There was finance income in that example. However, in this case, we are going to have a liability, not a receivable, but a liability and finance cost. The major difference in the accounting treatment relates to the initial treatment upon issue of the financial liability. Initially, these are recognized at net proceeds, being the cash received less any issue cost. Okay, therefore, if an entity looks to raise 10 million of funding but pays a broker $200,000 for raising the finance, the initial double entry is to debit 9.8 million and credit liability 9.8. Why? Because we said that in our diagram, the financial liability is going, if it is being held at amortized cost, it is going to be recognized at the purchase value less issue cost, less any discount. Okay, so this is why we have deducted the 200,000 from the 10 million, which was the amount which we intended to raise. Taking the 200,000 immediately to the settlement of profit or loss is incorrect, because this fee must be spread over the life of the instrument. This is effectively done by applying the effective interest rate to the outstanding liability. As noted earlier, the effective interest rate will be given to candidates in the exam. Here, the effective interest rate on the liability now incorporates up to 3 elements. It would incorporate the annual interest payable, okay, the annual interest payable, any premium payable on redemption or repayment, and any issue cost. This is shown in the coming example. We have got Yoliko, which issued 10 million 5% loan notes. All right, 10 million 5% loan notes on 1 January 20x1, incurring $200,000 issue costs. These loan notes are repayable at a premium of 1 million on 31 December 20x3, giving them an effective interest rate of 8.85%. Okay. In the above example, the 5% relates to the coupon rate. Okay, so this is the coupon rate. The 5% is the coupon rate or the interest payments, the rate at which the interest payments are going to be paid, which is the amount required as an annual payment each year. This is always based on the face value, that is the nominal or par value of the instrument. So this means that 500,000 would be payable annually, being 5% of 10 million. Using the wrong figure here is a common mistake in the financial reporting exam. The amount paid each year will remain the same throughout the life of the instrument and should not be calculated based on the carrying amount of the liability each year. As seen in the earlier example relating to financial assets held at amortized cost, the effective interest rate will be applied to the outstanding balance in each period. Again, a table is the best way to show our computation. So let's go to the next section. So as usual, this first column is for the year, okay, and this one is the opening balance. And remember, here the valuation, there's a potential that you might make this figure wrong. Okay, this is the value of the instrument at initial recognition, and we say that we are going to value this instrument at the purchase price less any issue cost and less any discount that has been given. Okay, and then this column is the P&L column. Okay, this is the P&L, the profit and loss column, the effective interest rates, which means every year this is the finance cost figure, which is going to be charged to the P&L. These are the finance cost figures. All right, and every year there is going to be a payment. Okay, these are interest payments and they are equal throughout. Okay, and of course this one is the principal, which include any premium and the original principal of 10 million. Okay, and then this is the column for the closing balances. Okay, note that the effective interest for 20x3 has been rounded slightly to arrive at the correct closing balance. Okay, this figure has been rounded. Okay, just to ensure that we are by the end of the day going to be left with a 0 there. Okay, Now, these are the entries which took place with regards to this example. Okay, on the 1st of January 2021, the loan note is issued, meaning that Yoliko receives 9.8 million. Okay, that's the amount this company is going to receive, being the 10 million less the issue cost. We have explained that. Therefore, the entries are debit cash 9.8 million and credit loan payable 9.8 million. Over the year, interest on the liability is accrued at the effective interest rate of 8.85%, giving the entry debit finance cost 867 and credit loan repayable 867. Okay, remember this is 8.5% multiplied by 9.8. Okay, 8.85% multiplied by 9.8 million. Please note that. Thank you. Okay, so ladies and gentlemen, when the payment for the 5% interest is paid, this is going to be the double entry. Okay, we debit loan payable to reduce the loan and credit cash to reduce the cash balances we have. Okay, now when we have paid the loan, the outstanding liability at the end of first year is going to be 10,167,000. This is given by, remember we started the opening liability was 9.8 million plus the finance cost, which we determined as 8.85% multiplied by 9.8 million, and we determined that it was 867. So plus 0.867 minus 500,000, 0.5. We will get the closing balance of 10.167. Now, ladies and gentlemen, this is going to be considered as a non-current liability. All right, it will be repayable at the end of on maturity. Okay, at the end of 2023. Okay, so by 31 December 20x3, that's when it will be due. Okay, so in 20x1 it will be considered as a non-current liability. You mustn't make a mistake of trying to split between the current and non-current liability component as you would do with a lease. For example, the non-current liability is only going to be found at the end of 31 December. Okay, the 10,567. If you go back to our table here, we are saying that the 1067, this 1067 is a non-current liability. However, this 1057 is a current liability. Why? Because it is going to be paid. It is repaid within 1 year. Okay, so at the end of 2002, we are left with a current liability only. Okay, that's the thing. And then in 20x3, we'll be having zero liability because we would have repaid everything. Alright, so that's the trick. Don't try to confuse lease accounting with this financial instrument. Now, I think I've saved a soul there because a lot of people make that mistake. If we look at the effective interest column, we'll see that the total is 2.7. That is the 867,000 plus 900 plus 933. The effective interest column we are talking about is this column. Okay, so we are saying if we add up all these we are going to get 2.7 million. Okay, that's 2.7 million. This is the total which will be expensed to the profit or loss over the 3-year period. This amount consists of 3 elements, namely the 1.5 million, which is the total of the 500,000 loan, interest repayments. Okay, the interest payments, all right, the annual interest payments, and the 1 million premium repaid at the end of the period. Okay, at the end of the three-year period, and then the issue costs. Okay, the issue cost. So they are going to be our costs for this finance. Okay, so as we can see, the issue costs have been expensed over 3 years rather than being expensed immediately in 2001. In other words, they have been amortized or spread over the life of the liability. This is the why we are saying we are using amortized cost. Okay, we are not going to expense all the costs which we have incurred in 1 year, but we are going to systematically spread them over the life of the liability. That's amortized. Amortized cost. Okay, so that's it, ladies and gentlemen. Let's see if we have other things to do. Now let's try this question, ladies and gentlemen. You can pause the video and then do the question on your own and come back to do it with me. Okay, Jiboako issues a bond for $503,778 on 1 January 20X2. No interest is payable on the bond, but it will be held to maturity and redeemed on 31 December 20X4 for $600,000. The bond has not been designated as at fair value through profit or loss. The effective interest rate is 6%. Required: calculate the charge to profit or loss in the financial statements of Jiboako for the year ended 31 December 20X2 and the balance outstanding at 31 December 20X2. Okay, this is a typical exam question. Alright, so you need to lead yourself by standing on the knowledge which you have gathered so far. Alright, now one thing I want you to see is that this bond does not warrant the payment of interest, but that doesn't exclude it from being accounted for as any other bond, okay, or as a bond that is giving the holders some contractual right to cash flows. Okay, the cash flow characteristics are still being met in this one. Okay, so we can as well account for it as at amortized cost. So we can use the amortized cost method to account for this. This type of a bond is known as a deep discount bond. Okay, it's a deep discount bond. One of the characteristics of a deep discount bond is that the interest is usually significantly below market rate. It is significantly below market rate. Okay, so we can still consider, we can still continue to account for this bond or to measure it at amortized cost. All right. Now, although there is no interest as such, the the difference between the initial cost of the bond and the price at which it will be redeemed is actually the finance cost. Okay, that's the finance cost. However, this must be allocated over the term of the bond at a constant rate on the carrying amount. All right, so we are still going to use the effective interest rate using this information available. All right, remember in the ACCA FR, the effective interest rate is always going to be given. However, in advanced studies, you will discover that you need to calculate this effective rate of interest, and it is usually determined the same as the IRR. Okay, still you can use the internal rate of return computations or technique to arrive at the effective rate of interest. Okay, so no need to panic there, but for now in the examination you are going to be given. So what is the charge to the profit or loss? Okay, what is the charge to the profit or loss? Remember, we said that the charge to the profit or loss is actually a multiple of the effective interest rate. So the charge is given by charge to P&L. Profit or loss is equal to the effective interest rate is 6%, okay, and multiplied by the bond issue price, which was 503,778, and this gives us, let me use my calculator, okay, 30,226. Okay, that's the charge to the P&L. Okay, now what about the balance outstanding at the end of the first year? Okay, at the end of 20x2. Okay, at 31 December 20x2. All right, so balance at 31 December 20x2. This one is equal to the 503,778, okay, plus 30,226. Remember, this is the opening balance plus the finance cost minus zero interest, because here we are told that it is not going to pay an interest. All right, so so the interest is zero, so we are going to have the total there of 534,778. Okay, that's the figure we are going to have. Sorry, I've actually copied the wrong figure from the calculator. Okay, that's 534. Okay, 004. Okay, the question was saying calculate the charge to profit or loss in the financial statement for the year ended 31 December 20x2, and we determine that this charge is 30,226, and then the balance outstanding would be we add that one to the original bond price. Okay, that's it. However, we do have to note that the total finance cost for this bond as I've indicated, the total finance costs are the difference between the redemption value and the purchase value. So 600,000 minus 538,776, and this is going to be the total cost for the bond. All right, so we use our calculator. Let me use my calculator here. So this is going to be 61224. That's the total finance cost for this bond. However, this cost was not required by the question. Okay, this was not required. So that is it, ladies and gentlemen. I hope we are enjoying the ride. Okay, there's a mistake there. Hold on. Okay, the figure should be 503,778, not 538,776. So the total cost should be 96,222. Okay, thank you. Okay, ladies and gentlemen, this is another example which we can learn to do. Which we can use to further test our understanding. Alex Co. issues 6% loan notes with a nominal value of $200,000. They are issued at a 5% discount, and $1,700 worth of issue costs are incurred. The loan notes will be repayable at a premium of 10% after 4 years. The effective interest rate is 10%. What amounts will be shown in the statement of profit or loss and statement of financial position at the end of years 1 to 4? Okay, usually in the exam, you are not required to determine amounts for such a longer period. Okay, usually you are required to determine amounts for 1 or 2 years. Okay, but let us do this question to further our understanding in this area. Okay. Okay, once again, you can see that if you're given a question like this in the exam, the examiner is hinting you to use the amortized cost basis. All right, the effective interest rate is actually an important ingredient in doing a computation for amortized cost. So let us come up with an amortization table. Ladies and gentlemen, an amortization table looks like this. Okay, we have got first column, years. All right, and then we have got the balance BD. Then we have our effective interest. Effective interest rate. That is, in this case, we are told that this is 10%. Okay, it is 10%. Then we have got the payments. All right, interest payment. Sorry. Then we have got the closing balance. Okay, the balance CD. Now, the first hurdle is to determine our opening balance. Okay, what is the opening balance? We are told that we have issued loan notes worth $200,000, and these ones are 6%. All right. Now, the 6%, this percentage here, that rate is only for the determination of cash flows, the interest payments. So it's not important for now. All right. Okay, to avoid confusion, you can determine the annual interest payments at once, because this figure is going to be constant throughout. So that's 6% multiplied by 200,000, and this gives us the payment of 12,000. So you slot the 12,000 throughout for the 4 years. All right, year 2, year 3, year 4. So it will be 12,000, 12,000. But for the okay, this will be 12,000. It will be plus this 12,000. Okay, so for the 4th year, it will be plus 12,000. There is the other figure plus the 12,000. Okay, and let us not forget that these are payments. Okay, so they are in brackets. So whatever figure will be in brackets. Okay, now let's determine the opening balance. We are told by the question that the purchase value was 200,000 and they were being issued at a 5% discount. Okay, so technically this will be the purchase value would be 200,000 multiplied by 0.95 to include the discount. Okay, minus also the issue cost of 1,700, remember. Okay, and the figure would be how much? Let us use our calculators. So that's 188,300. So this will be taken here to be our opening balance, 188,300. Okay, and then we subject it to the effective interest rate of 10%. So if we multiply 188,300 by 10%, we are going to get 18,830 as our effective interest. Okay, and remember that's the charge that is going to be taken to the P&L that year. The P&L that year. Okay, so 188,300 plus 18,830 minus 12,000, we are going to be left with 195,130. That's the closing liability. Okay, then we take that figure to year 2, 195,130. Okay, multiply by 10%, we are going to get 19,513. Then we deduct 12,000, we are going to be left with 202,643. We take that one as our opening balance, 643. Then we subject it to 10% and we get 20,643. I mean 20,264. 20,264. Okay, if we deduct 12,000, we are going to be left with how much? This calculator of mine, 210,000 907. 210,907. Okay, we take that figure and slot it in this first column. Oh, it's 210, sorry, 210,907. Okay, now 210 907 multiplied by 10%. That's how much here? That will be 21091. Okay, 21091. Okay. Now, we are told that the loan notes will be repayable at a premium of 10% after 4 years. So that's, we are having 200, okay, as the purchase value, 200, and then we need to add 10%. So that's multiplied by 1.1, and we are going to get 220, okay, 220. This should be the redemption value. So we need to say here 220 plus 12,000. So the 220 plus the 12,000 are going to be repayable, okay? And by the end of the day, we should be having a zero, okay? Sometimes, as in this, let me just try to see, it's not usually going to be exactly a zero, but it should be around that. Okay, let me try to punch in my calculator and see. 210907 plus 091, okay, minus 220000 minus 12,000. Okay, it's giving me minus 2. Okay, it's giving me minus 2. So you can see that it's an issue of rounding. Okay, it's actually an issue of rounding. So you can get a figure, but it should be at least closer to the amount of 0. All right, so that's the idea when we are talking about amortized cost. Okay, let me see if we still have another question which we can use as a practice question. All right, I'm sure we have got this one and we can quickly give it a go. Okay, Chris issues 4% loan notes with a nominal value of 20,000. The loan notes are issued at a discount of 2.5% and $534 of each cost are incurred. The loan notes will be repayable at a premium of 10% after 5 years. The effective rate of interest is 7%. Interest is payable annually in arrears. What amount will be recorded as a financial liability when the loan notes are issued? What amount will be shown in the statement of profit and loss and SFP for year 1? Yes, this is actually typical of our exam for year 1 only. All right, so let us give it a go. Okay, I've quickly drawn my table, and then I now need the figures. Okay, remember we are only looking for the figure for the figures in year 1 only. So what's the opening balance? The opening balance, we know that these loan notes are issued at a discount. Okay, so that's 20,000. Okay, and the discount is 2.5. Okay, so 2.5 of 20,000, that's 500. All right, so 500, that's the discount. Okay, and the issue costs are 534. So this is going to give us 18,966. So we'll use this as our opening balance, 18,966. Okay, so we come to our table and say 18,966, and then we know that the effective interest according to the question is 7%. Okay, the effective interest rate is 7%. So we use that figure. All right, 7% multiplied by 18,966. That should give us 1,328. Okay, and then we know that the payments are going to be 4%. Okay, 4% of 20,000 every year, so that's $800. So this is the payment. Okay, and if we add 80,966 plus 1,328 minus 800, we are going to be having a liability of 19,494. And remember, this is how many years now? This one, 5 years. Okay, it's a 5-year loan. So obviously, this figure is a non-current liability. That's a non-current liability, and the finance cost is going to be this figure. So this one appears in the statement of profit or loss, and this one in the SFP under non-current liabilities. I think we have done justice to this area. Let us now go to the hybrid instruments. Hello, ladies and gentlemen. We are now inclined toward the end of our lecture, but we need to cover this gray area on compound or hybrid instruments. A compound instrument is a financial instrument that is of both equity and liabilities, such as a convertible loan. A convertible loan has the following characteristics. It is repayable at the lender's option in shares of the issuing company instead of cash. The number of shares to be issued is fixed at the inception of the loan. The lender will accept a rate of interest below the market rate for non-convertible instruments. As the lender is allowing the company a discounted rate in return for the potential issue of equity, these convertible instruments are accounted for using split accounting, recognizing both the equity and liability components. There is a liability or debt element, as the issuer has the potential obligation to deliver cash. There is also an equity element, as the investors may choose to convert the loan into shares instead. The accounting for a convertible loan falls into 2 stages: initial and subsequent measurement. Now, accounting treatment for convertible loans. Initial recognition. The liability is measured at its fair value. The fair value is the present value of the future cash flows, interest and capital discounted using the market rate of interest for non-convertible debt instruments. The equity element is equal to the loan proceeds less the calculated liability element. Subsequent measurement. The liability is measured at amortized cost. Initial value plus market rate interest less interest paid. So this is just the same as what we have been doing using the amortized cost. That is at subsequent measurement level. The equity is not remeasured and remains the same value on the statement of financial position until the debt is redeemed. So the equity element is just going to be static throughout the loan period. Okay, now let us look at a particular example to send the point home. Okay, ladies and gentlemen, this is our question, and the question is just right in front of our eyes. King Ginger Co. King Ginger Co. issued 10 million 5% convertible loan notes on 1 January 2021. These will either be repaid at par, that is at 10 million, on 31 December 2023, or converted into 10 million ordinary 25 cents shares on that date. Equivalent loan notes without the conversion right carry an interest rate of 8%. Relevant discount rates are shown below. So, equivalent non-convertible loan notes are carrying an interest rate of 8%. So we need to use the 8%. Okay, we need to use the 8% in our discounting. All right, so you need to be aware that the other percentage that has been put across by the examiner here is just a red herring. Okay, although we still have an applicable 5% that is going to be useful for our computation when we now do the amortized cost technique. Okay, but however, we need to first determine the liability and equity components. Okay, we need to first determine the liability and equity components. All right, so it is important to note that the 5% there is not applicable. The only thing we need the 5% for is to work the annual interest payments. Okay, as I've indicated, as they are 10 million 5% loan notes, this simply means that King Ginger will need to make an annual payment of 5% multiplied by 10, that is 500,000 in the amortization table, remember. Therefore, we can work out the value that the market would place on these loans, on these loan notes, by looking at the present value of all the payments discounted at the market rate of interest. If this was a normal loan, ignoring the conversion, King Ginger would pay 500,000 in years 2x1 to 2x3 and then make a final payment of 10 million on 31 December. All right, if it was just a normal non-convertible loan. As the market rate of interest is 8%, the present value of these payments can be calculated, and these are calculated as follows. So let's see how we go about the computation. So ladies and gentlemen, here this one is not an amortization table, this one is a present value table. Okay, I mean the present value or cash flow computation, discounted cash flow table. All right, so we know that every year we are going to make a payment of 500, and then 10 million plus 500. Okay, 10 million plus 500,000. All right, but we need to discount this so that we get the present values. Okay, so if we multiply in year one, if you multiply 500,000 by the discount factor at 8%, then we are going to get 463,000, and then year two, this becomes 428.5 thousand, and then in year three we are going to get this amount. Okay, now the present value of all the payments can be seen as 9.22. So this is the total present value, 9.229 million. This means that King Ginger Co. received 10 million, but the present value of the payment have an initial present value of only 9.229. As a result, the holders of the loan notes are effectively losing 771,000 compared to if they had simply given King Ginger Co. a normal loan at the market rate of interest. Okay, so this is the other way of getting the same figure. Okay, we can use this technique, okay, used to arrive at the same figure by using an annuity from the annuity table, okay, the annuity formula. Okay, that is that. Now we have determined that the liability component is 9.229 million. Okay, and the equity component. The equity component, ladies and gentlemen, is that balance, the balancing figure. Okay, this 771,000. All right. Now I need to point out this point. Okay. Okay, ladies and gentlemen, we are saying that the liability. Okay, so we are saying the liability. What's going on? The liability component is equal to 9.229 million, and the equity component was 771 million. I mean 0.771 million, or give up a total of 10 million. Okay. Now, the 771,000 is actually the amount of interest the debt holders are willing to lose in order to have the option of converting the loan into shares. Okay, so they are motivated, they are prepared to lose that amount. Okay, that's their cost of having the option to convert their the amount which they borrowed, or I mean which they lended, so that they will enjoy the option of converting that amount into shares of the company or of the borrower. All right. So at inception, that is on 1 January 20x1, the following double entry is relevant. Okay, we're going to debit cash. All right, the cash was 10 million. Okay, this reflects the full cash received from the issue of the convertible instrument. Okay, and then we're going to credit something. All right, we're going to credit the convertible debt. How much? The convertible debt is 9.229 million. And then we're also going to credit equity. This equity, ladies and gentlemen, is not the ordinary, is not part of our share capital. It's not part of the borrower's share capital, but it is considered in other components of equity. Other components of equity. Okay, so it is the reserve for convertible debt. You can just say in bracket reserve for convertible debt, which was 0.771 million. Okay, so the double entry balances so far. Now, I also want to highlight that the balance on the equity would be held as a reserve for convertible debt within other components of equity. It would be incorrect to include it within share capital. This is a common mistake with most FR exam students. So subsequently, this equity amount remains fixed until conversion, but the liability component must be held at amortized cost. Okay, so we need then to do the amortized cost computation. for the liability. However, the equity will remain static, will remain unchanged throughout until redemption. Okay, so this must be 10 million by the end of the 3-year loan note period. So the liability, the liability itself should be held at 10 million. Okay, so this must be 10 million by the end of the 3-year loan note period to reflect the amount which the holder would require if they demand repayment rather than conversion of the loan note. So by the end of the day, our amortization should lead us to a total payment of 10 million. Okay, all right, am I talking to somebody? All right, however, the opening balance of this liability is 9.22 million. However, the liability itself should total up to 10 million. All right, you will see with the amortization table as we are going to do it. Just hang on, stay tuned. Okay, ladies and gentlemen, that's the amortization table. We have got the year columns, all right, and then the balance brought forward, the opening balances, effective interest rate at 8%, and our payments. Okay, the payments, as you can see, they are in negative. The negatives, okay, negative 500, negative 500, as you can see there. All right, the opening balance of the liability is still 9.29, as you can see there. Okay, and the effective interest rate, that's 8% of 9.229. That's this gives us an amount of 738. Okay, and if you add 9.229 million plus 0.738 million minus 500,000, you are going to get 9.467. So it's still the amortization table which we have been doing so far. All right, note that the effective interest rate for 20x3 has been rounded slightly to arrive at the correct closing balance. So here, because we want to ensure that at the end of the period we only have to pay, we're not going to be left with an outstanding liability, then we need to have a zero. So you can see that at the end of the period we must have a zero in this column. However, since we have in this table we didn't deduct the principal, which is also going to be paid in this year, all right, we are left with the 10 million. However, this 10 million, after it has been paid, it means that the outstanding liability will be zero. Okay, so as with the non-convertible financial liability noted earlier, the effective interest rate column is taken to the statement of profit or loss each year as the finance cost. So this is where our finance cost is situated. At the end of 3 years, King Ginger Co will either repay the 10 million liability, or this will be converted into 10 million $0.25 shares in accordance with the terms of the instrument. Okay, with the 10 million balance and the reserve for convertible debt balance of 771,000 transferred to the share capital and share premium or other components of equity as required. Okay, so by the end of the day we need to have a zero balance there. Okay, perhaps we need to do another question, which I think should be the last question on these convertibles, so that we close our case as super dupers. Okay, let us try this question. Okay, I think I need to explain further the issue of this outstanding 10 million at the end of the period. Okay, unlike in the ordinary liabilities or loan notes, with convertible instruments, we are saying that the holders have the option to require the payment of their 10 million or to opt for the conversion. Okay, so this is why we are saying that at the end of the period, either King Ginger will have to repay the 10 million. Okay, they need to repay the 10 million, or this will be converted into 10 million at the instance of the debt holders. They might opt to have the loan settled by a conversion. All right, so this is why we do not automatically consider it to have been repaid. Okay, because there's still an option. These debt holders, the debt holders might require the company to convert. They might require the option for conversion, so to be paid through the issue of shares. Okay, so that's the reason why you need to put the outstanding liability at the end of the period intact. Okay, just have to leave it intact. Do not assume that it has been paid. Okay, so let us try with that position this other question. Okay, let us try this other question. Now, convertible loan 2. So the question is Odenco. Odenco issues a convertible loan that pays interest of 2% per annum in arrears. The market rate is 8%, being the interest rate for an equivalent debt without the conversion option. The loan of 5 billion is repayable in full after 3 years of convertible equity. After 3 years of convertible equity, or convertible to equity. Discount factors are as follows. Okay, so we are given the discount factors here, ladies and gentlemen. These are our discount factors at 8%. In this case, the examiner didn't want to confuse us with another irrelevant discount factor column. Okay, so they've just given us the rates in line with the market rates there. So we are going to use those as discount factors in our computation for the liability element. Okay, so let us start what we have to do at inception. All right, let us start with what we have to do at inception. So at inception, this is what we are going to do, ladies and gentlemen. We need to come up with the discount table. Okay, so we'll be having years, all right, cash flows, discount factor. Remember, this is at 8%. All right, and then our PVs. So this is our PV table rather. Okay, so in year one, we are going to receive how much? We are told that the cash flows, all right, those are the interest payments, all right, so that's 2% per annum, 2% per annum on 5 million, all right, 5 million, so that's 2% multiplied by 5 million, and you see that this figure is 100,000. So that's 100. You can put thousands here. The examiners would want you to be very systematic, and you need not to ignore certain important information. Okay, so you put your thousands there. So you know that the cash flows are always going to be the same. All right. Then in year 3, the cash flows would be including the principal. Remember that. So the principal is 5 plus the interest. So that's 5.1. Those are the cash flow. We need then to discount them, and the discount rates have been given, the discount factors. So that's 0.926, 0.857, 0.794. Okay, so if we multiply across, that's 92.6. Okay, 92.6, then 8, 5.7, and then this one should be 4049. You'd add across, you must get a total PV of how much? Okay, you can also not close here. Okay, so you must get your 4,228. Just round up. Okay, 4,228. All right, and then that's your liability component. So you can call this figure, the debt element. Okay, and then you know that the loan was 5 million. Okay, in total the loan was 5 million. So by the end of the day, it should total up to 5 million. So the balancing figure is what we call equity. Equity is the balancing figure, which is equal to 772. Okay, so the equity part is 772. Now, having found that, you then have to move on to the next part of the question, where you do your amortization. So let's draw, ladies and gentlemen, the amortization schedule. Remember, this 5 million, you can call it the cash received, the cash that was received when we issued the loan notes. Okay, so the amortization table is the next one. So you start with your years, opening balance, okay, or balance BD, okay, and effective interest at what percentage. The question was saying something, I think it was yes, 8%. So at 8%, then the payments, and then the balance CD. Okay, so we have got year 1, year 2, year 3. All right. Always remember that the opening balance there in year 1 is the amount equivalent to the calculated liability, this figure 4228. In the exam, the examiners would be happy if you did it wrong here, and then you just extracted that wrong figure straight away to the first place there, the first column there in year 1, okay, as your first opening balance. Then you are not going to be penalized. Okay, so you just have to be consistent to show that you know what you are doing. All right, you multiply this figure by 8%, and you must get your 338, and then you deduct by the annual payments, which we determined earlier on that they were 100. So that's 100, which is the interest payment, and then you rest your case with 466. You do the same throughout the whole table. Okay, so like in the unlike in the ordinary liability computation, we are still not going to assume that in the final year both the principal and the interest were repaid. Why? Because there is that option that is still lingering. So we will put the 5 million as our closing liability then. Why? Because we want to leave it upon the debt holders to decide whether they want to convert or they want the ultimate repayment of the principal. Okay, so let us now then consider the double entries. Okay, because without knowing the double entries, then we will not be doing anything. Okay, so we need to then master the double entries for this problem. Okay, from the initial part to the end of the, okay, because the question was saying that you need to split the loan between the debt and equity at inception and calculate the finance charge for each year until conversion, and the finance part is the effective interest column, remember, and then also show what amounts will be shown in the SPL and SFP for years 1 to 3. So let us do that in the next part of this video. Okay, going ahead with the double entries. Now, the double entries rely on our computations initially, because when the convertible bonds are issued, obviously this part here applies. Okay, this is the part that is applicable. All right, when we issue the convertible bonds, the double entry that is going to happen is that we are going to debit cash. Let me use a pen that is more visible. Okay, we are debiting cash. How much cash are we debiting here? That's 5 million. But we are also crediting, remember, we are crediting the debt as well as the equity. So credit debt, how much? 4.228 million. We are also crediting equity. How much? 0.772 million. That's the double entry that happens, okay, when we issue. But now, in subsequent periods, then that is at the end of year 1, this is at inception. This is at inception. Okay, now at the end of year 1 up to 3, we then have to be very systematic. So we have 2 positions where we need to report. Let's start with the statement of profit or loss. Now, we are having how many years? 3 years. So 1 to tabulate and see what we are reporting in these years. Okay, so in the statement of profit or loss, we are having an animal called finance costs. The finance costs, like I said, these figures are found in our amortization table. So for year 1, that's 338, year 2, 357, year 3, 377. So we are going to slot in these figures. So that's 338, 357, and 377. We are done with the extract statement of profit or loss. Then let's talk of the extract statement of financial position. So in the statement of financial position, we are going to have 3 years again. 1, 2, 3. Okay, under the equities and liabilities. All right. We're going to have the equity option. Equity option, or in bracket the other components of equity. The other components of equity, we are going to have these figures. Remember, we determined that the equity is not going to change. So this figure, the 772, is going to be there constantly, indexed. So the 772, 772, 772 throughout. Okay? That's the amount we are going to have. All right, and then we go to the liability. We also have a non-current liability to be reported. Okay? Okay, we go to our amortization table. Okay, the amortization table is going to lead us here. Okay, so our non-current liabilities are going to be the first two figures, this one and that one. So in year one, that's 4466, 4466. And then in year two, that's 4723. Sorry. Now, what about, so in year three, we are not going to have a non-current liability, but we'll be having only a current liability. Okay, the current liability in this case, that's the 5 million we need to consider for repayment, or the holders might opt for a conversion. Okay, however, IFRS 9 requires us to disclose that liability. So 5 million. Okay, that's the current liability. Should be recognized. Okay, I think we have done much about this topic area, and everyone is home and dry. Now let's discuss a bit about these issues before we rest our case. All right. Okay. Now, derecognition of financial instruments. Derecognition is the removal of a previously recognized financial instrument from an entity's statement of financial position. An entity should derecognize a financial asset when A. The contractual rights to the cash flows from the financial asset expire, or B. It transfers substantially all the risks and rewards of ownership of the financial asset to another party. We have seen that when we were talking about the factoring of receivables. An entity should derecognize a financial liability when it is extinguished, that is, when the obligation specified in the contract is discharged or cancelled or expires. Okay, you don't just derecognize an obligation, a liability. You need to ensure that it has been extinguished, that is, the obligation has been as specified in the contract, has been discharged or cancelled or expires. It is possible for only party of a financial asset or liability to be derecognized. This is allowed if the part comprises A. Only specifically identified cash flows, or B. Only a fully proportionate pro rata share of the total cash flow. For example, if an entity holds a bond, it has the right to two separate sets of cash flows, those relating to the principal and those relating to the interest. It could sell the right to receive the interest to another party while retaining the right to receive the principal. On derecognition, the amount to be included in net profit or loss for the period is calculated as follows. The carrying amount of the asset or liability, or the portion of the asset or liability transferred, less proceeds received or paid, then the difference to profit or loss. Where only part of the financial asset is derecognized, the carrying amount of the asset should be allocated between the part retained and the part transferred based on their relative fair values on the date of transfer. A gain or loss should be recognized based on the proceeds for the portion transferred. Now, IFRS 7, Financial Instruments Disclosure. The objective of IFRS 7 is to require entities to provide disclosures in their financial statements that enable users to evaluate A, the significance of financial instruments for the entity's financial position and performance, B, the nature and extent of risks arising from financial instruments to which the entity is exposed and how the entity manages those risks. This information can influence a user's assessment of the financial position and performance of an entity and the nature of its cash flows. In addition to the numerical disclosures required by IFRS 9, IFRS 7 encourages a narrative commentary by issuers of financial instruments which will enable users to understand their attitude to risk. Ladies and gentlemen, I'm sure I have exhausted much of what is required for you to pass the ACCA paper financial reporting with regards to financial instruments. If you feel you need, there were certain gaps which were not attended to, please indulge your views on the comment section below this video. Okay, like I said, please make use of this diagram for you to have a general understanding of financial instruments. Let me just display the diagram here. Okay, ladies and gentlemen, this has been, I guess, a wonderful presentation that is going to take you somewhere. Okay, if you feel like you need further coaching and assistance in your ACCA studies, please don't hesitate to contact me. And these are my contacts. Let me just show you a bit. Okay, those are my contacts. We can move together. I'll never leave you alone throughout your studies, and I will be ready to assist you. Please don't forget to subscribe, comment, and share this video just for you or for the posterity, okay, for everyone to benefit. Until next time, ladies and gentlemen, may you continue to feel excited, very, very excited. I am signing out. Bye.